All right, everyone. This is Brian Overby, Senior Options Strategist with Options Play. It is now time to kick off our review of the markets and look at a few ideas that we have going forward over this week's earnings report. I'm going to share with you a couple of my favorite strategies by logging into the Options Play platform inside the Firstrade option chains, i.e. the options wizard, and talk about a few ideas with a whole bunch of earnings that are going on at this point in time. Currently, we see that the S&P futures is up just a tad, but it's looking like, once again, we're bumping up against that 7,000 range and an all-time high in the SPX. Right now, we see the markets are up about 15 points in the S&P 500 futures. The Dow futures are basically flat at this point in time, and the NASDAQ futures are right now up 133 points, or about a half of 1%. So the markets are being resilient in spite of government shutdown, a partial shutdown. Not a lot of people are talking too much about that, but we still see the VIX kind of hanging in right around the 16 range, showing a little bit of uncertainty. Definitely climbed higher heading into this week, and now the concerns have kind of waned a little bit. So, the 10 years stays strong as far as the bond yields are concerned. The shorter term interest rates, the Fed did nothing. And so far, we see that the yield curve has been strong as far as financial companies are concerned. And I do like financials in this space, in this environment. Also looking at a lot of the Mag 7 that are going to be announcing this week. An interesting stock that I do think on the open might get a little bit of a bounce is Disney. The chart looks real interesting on Disney. They're talking about Bob Iger's successor, but the stock had a fairly strong earnings report, and it was down 7.5% yesterday after a solid earnings report, trading at 104.45. And I do expect, and I'll talk a little bit about Disney to start. I do expect to see a little bit of a bounce in Disney today. I think that sell-off was a little bit overdone. We'd known that Bob Iger is leaving for quite some time, so I don't really know exactly why the stock sold off as strong as it did, but it did. And we're going to look at an opportunity in Disney to go along with it. All right. I am sharing my screen. You should be able to see the slides. Before I get too far along, I always have to talk about some important information. If you're going to trade options, you need to read the characteristics and risks of standardized options. The PDF is available throughout the Firstrade site. If you'd like a hard copy, you can ask them for it. Today, we're going to be looking at real examples, and don't forget that you got to include commissions and fees and margin interest on any of the examples that we're going to be looking at today. Nothing is meant to be a recommendation or advice. Past performance is not a guarantee of future performance going forward. So let's leave that there. Let's get into the Firstrade platform. So when I am looking inside the Firstrade platform, one of the biggest things that I like to start with is just look at the ideas tab and some of the different watch lists that are available in the different sectors. Now, we've added a few of the bullish and bearish signs, and so from the trade ideas, if you are interested in highlighting some of the 332 different ideas, some of the things that we can look at is a bullish or a bearish trade. If you want to get rid of the bearish trade, you just got to click on the bullish trades. And then I also like to go and look at the strength. I like to say bullish strength. This is referring to the relative strength of the marketplace. Ideally, you want lower strength. That means it's the beginning of the upturn. and look for some different ideas inside the, I guess, list ranked by relative strength. So I'm just going to pull up DocuSign. We'll take a real quick peek at that, and we'll look at the signal that we get. Here we get a bullish counter trend signal inside the platform, and this highlights the different trends that are available. I always like to get rid of not liquid. I almost wish that we could make it default to that so that we don't have to click on that whenever. I don't really want to be trading non-liquid stocks. I also like to start somewhat by getting rid of the somewhat liquid and see what we can see with the very liquid. Right now we have a bullish counter trend. That means that the market, it has been beat up, and let's get over it here. And now it's been a little bit overdone. So the way I like to look at a bullish counter trend is that you are bottom fishing. You are trying to catch a falling knife, if you will, in that we've been beat up, saw a little bit of signs of bullishness, and now at this point in time, we think that it's been extremely bearish and has exhibited signs of a potential reversal. We have quite a few in here that show up on the bullish counter trend after a big downturn, and you will see that in quite a few different stocks. The ones that I want to focus on today, though, are companies that are going to be announcing earnings, and I want to talk a little bit about how I like to approach those earnings. But now I want to look at Disney, because I think Disney is an interesting stock today. In that, let's pop up the chart. Let's look at adding some trend lines, and let's go out the 6-month time frame and zoom on in. Okay, so right here, and we came all the way down. One of the things that I think is, well, let me try that again. All right, that is interesting in Disney is all of the noise that happened right in this area, right? Let's go back and just look back. You can see down at the bottom of the screen that we're talking about March of 2025. Here was a downturn, a big downturn, then a bigger gap down. This is where the underlying stock has came to now. So ahead of that earnings report, we saw the stock drop right through this entire gap, all the way down to the downside, right here at this point in time. This is part of the reason why I think, considering that the company's actually made some headwinds, had a fairly strong earnings report and an outlook going forward, things are starting to pick up in the Disney world. And you see that this gap was actually filled all the way to the downside. So if we do make that bounce, I don't think it'll be hard to come back and fill this gap to the upside once again. If we break down, then we're going all the way down to here to the bottom of this downturn where we had this real solid candles, not to mention the fact that this gap filled here. So I think you have really strong support around the 101, 102 range. Now, also some support at the bottom, right where we're at, right here. So this is a precipice in Disney. Now, you can play it one of two ways if you're looking at this, is you say, well, if we do get that dead cat bounce, well, this is one of the lines that is drawn, and this is a little bit of the resistance to the upside right here, right at 106. But if we did get down to this range, right at the bottom of this candle, this is definitely a buying opportunity in Disney. As a matter of fact, I don't mind looking at that as a fairly bullish signal. If we do, obviously, but if we were to break below that level, well, then we could go all the way down to this level as far as the chart is concerned and fill this entire gap that is being highlighted all the way back in March. So I don't think that there's major news that would make that happen at this point in time. So if you're looking just as a long-term buy of the underlying stock, I think Disney at this point in time is an interesting purchase of stock. If you want to speculate and you see it come down to the one, we'll call it, I'll put it right here. I'm going to go right at the bottom of this candle right there, 101.70. 101.70 is the area that I would target. And if that happened, I do think that potential to actually just even buy some long call options going into that trade. Now, the other stocks that we have that are announcing tomorrow that I think that are of interest is Uber. And Uber, let me close this. And if I look at Uber stock, and I wanted to play that inside the options wizard, we do have some bullish signs on Uber. Apologize for my typing. And kind of, there's been some negativity in the chart, in that here's the 50-day crossing over the 200-day, and we also are the 20-day crossing over and the 50-day crossing over. So the stock has been negative. Let's go back out to this range once again here, and you see a lot of noise going all the way back to April of 2024. This area once again is an area of support and resistance, of consolidation, if you will, in Uber. Maybe the earnings report can get you back to the upside. And if I were to look at Uber right here at this range heading into this earnings report, the way that I would approach the trade, and I apologize, I didn't mean to get rid of that. Come on back. I wanted to hit escape is what I wanted to do. Is I sometimes like to straddle a stock if I'm looking at a potential bounce around earnings. So Uber, we have a very liquid underlying stock. The IV rank is at 44, so it's not outrageous for an earnings report, but volatility is definitely high. They're going to announce before the open tomorrow. And if you want to get bearish a little bit more long term, if you want to get bullish, and this is more so you're looking for a turnaround stock, but the marketplace is right now showing that it's bearish as far as the platform is concerned. We're looking for a little bit of a bounce right around earnings and see if this support would hold, but it's definitely had a bearish trend in the 1 month and in the 6 month. All right, so here is the a longer term vertical spread, and the platform will almost always default to a longer term. You can adjust that a little bit, but here let's modify the trade. I like to straddle stocks that are announcing earnings, where I'm literally going to make this a 50-50 play around earnings. Now, earnings are very speculative, not meant to be a recommendation. So if I look at the earnings play here, and I'm going to modify this, we're going to go down and look at 10 days on this position. It's going to be all about the earnings. And with the stock at 80, we're going to go down and buy the 75 call. Or I'm sorry, let's go to the 77. I want to go 5 points wide, not 5 points in the money. And on the upside, we're going to look at the 83 call. So we're going to be equidistant in and out of the money. Now, if you look at this before we even pull up this trade, this should be trading for fairly close. Well, we're a little bit in the money. We're 80.84. So we're a little bit in the money. So but it'll be fairly close to $3. by placing the trade. Now we're leaning a little bit in the money, so it's not quite there. And the reason why I knew what the price was before we pulled it up, or somewhere close to that, is because if you go equidistance in and out of the money, what you are doing is you are buying as much time premium on the 77 strike call as you are selling on the 83 strike call. So by doing that, you make the break even very close to where the actual market is at. And right now with the stock at 8, if it was right at 8, so with that rationale, if it was right at 80 in theory, this should trade exactly for $3. You're $3 in the money on the 77 strike call, and you're $3 out of the money on the 83 strike call. And because of the way time premium works, it's always centered on the at the money option contract. You should be risking 3 for the potential to make 3, and you take the time premium out of the option contract. And I do see we got a couple of questions here, and I'll try to address some of those questions in just a bit here. No, it still goes back. It looks like you are able to see the screen, everybody, right? I think so. Okay. And so here is the preview. Let's go trade on this. And you'll notice that the profit and loss is almost a 50-50 split on the way down and on the way up. Now, we're a little bit, not quite 50-50, but we are also a little bit more in the money. Now, this is interesting in that with this earnings report, if you look at the break even on this underlying, like where we cross the x-axis, where the 0 point is at, that is going to be at 77 plus $3.21, or $321 per 1-by-1 vertical spread that is put on, and that would be at 80.21. So the market could actually come down a little bit and still be profitable on this trade. Well, it also implies that you are buying a little less time premium than you are selling. So we are doing a debit spread. The total risk of this trade would be $321. The max reward would be $279. It's obviously going to be within the expected move after the earnings report. I didn't look at what the expected move is at by looking at the money long straddle, but you would expect that after earnings the stock could move at least 3 points in either direction. So with the trade on, we're going to give it only 10 days until that expiration date for it to play out, but realize that this is more of an all or nothing trade. You're taking out all the headaches of trading around earnings, implied volatility, where the different things are the implied volatility in the option contract, the potential for the implied volatility crunch after the earnings report, seeing implied volatility go down, and you're making it all about the earnings report and which direction the underlying stock goes. And I think Uber is interesting once again because we're right at that precipice period of consolidation, ran up, bounced off of the 200-day moving average, and we're sitting right here looking for that catalyst to maybe turn the 20-day MA and at least have a golden cross above the 50-day moving average right here. All right. So that's Google, and I'll look at a few of other stocks that you might be interested in, but I'll keep trudging along. If you have, like I said, a plethora, over 800 companies announcing over the last, basically the last 2 weeks, this is the week of earnings. So if you have any that you would like me to look at or review, I'm happy to try to review them. Let's get to the main ones though here. Google, i.e. Alphabet, they're going to be announcing on Wednesday after the close. I want to confirm that. Yes, they are announcing. Come on, I need my site to move up. They are moving after the close on Wednesday. Alphabet's going to be announcing. So Google has been the most resilient of the AI plays, getting a lot of accolades for their Gemini platform. And if we go back and look at the chart, let's pull it, make it so it's not so parabolic, and we'll scroll back out just a little bit. It's hard to do though, right? Market's really been moving to the upside. 200-day, if there's anything that concerns you a little bit, is we're getting a little bit extended from the 200-day moving average, but we have our ducks in a row. We got the 200-day, we got the 50-day, we got the 20-day. You like to see them stacked in that direction, showing that this is a real strong stock. And with Google, if I want to lean with the bullishness that has been happening, and as far as Google is concerned, one of the strategies that I like to highlight when I get a pulpit like this to talk about option trades is a open wing butterfly, and I'm going to highlight that trade for you. It's a little bit more advanced, if you will. I don't like that. Let's try this. There we go. Dang it. It keeps closing out. I'm sorry about that. I'm not as used to trying to get out of the chart. And with Google, so I'm going to modify this. Now, this isn't highlighted because it's a fairly advanced trade in the options world, but the bullishness is still there. We're 10 out of 10 on the bull side on the relative strength. That could be hinting that we are a little bit overdone on the upside just because we had such a strong move. But let's take a peek. One of the things about Google is or Alphabet, I should say, is they don't, their earnings reports aren't as raw as a lot of the other companies. They're really straightforward, very blunt, very honest about what's happening in the marketplace, and also, not shocking the market, trying to come up with new reasons to push the stock, right? So they're just very straightforward with their earnings reports. And if we modify, I'm going to look at modifying the call vertical. It's still showing that it's a bullish trade, and I think that this is an alternative to a call vertical spread. So let's look at a very speculative, thinking that this strong momentum is going to continue going into earnings. And I will modify this trade, go off the bid and ask. 73 days around earnings. I never want to put up that much capital because it's really all about earnings. So 24 days is about as far as I want to go out around earnings. I don't even mind going around 10 just because you're going to have less capital up front and it's all about the earnings. So somewhere between 10 and 24 days is usually my outlook around earnings if I'm looking at doing bullish call spreads or bullish put spreads. All right, and let me get my Q&A box back up, make sure I'm addressing any questions. Okay, somebody would like to look at the report that Tony puts out. Okay, I can do that too. Before the show ends. All right, no problem. Let's look at Google, modifying the trade, and we will go down to 24 days. Actually, if we're going to do, we'll stick with 10 days and we'll highlight the 10 days and we'll look at a spread and then I'll look at an alternative on the long call spread. Stocks at 343. The site is recommend going about, usually buying a little bit in the money and then selling something right around a 20 delta. So we're modifying this one. So this is giving a little bit too much upside on the stock. 340. Here's the 20 delta. 28. So you're right at the one standard deviation move is either looking at doing the 370 and pulling in around $3.20, but this is going to take the midpoint, or looking at the 370.250. We'll do the 370 to make it just a very straightforward, simple strike. So in this instance, you're paying 14 for the 340 call, receiving 325 for the 370 call. That's looking at a one standard deviation move over that 10-day period. And the risk reward is almost double, right? You're paying, well, a little less than double. Ideally, you would like this to be, the reward would be 2,150. That means that you're doubling what the risk is. That's usually the goal, and usually we'll end up with a little bit of a higher options play score when you get something that highlights a double on the underlying stock, but not a bad score, 106 on the trade. All right, so as an alternative to this, the total cost and the total risk is going to be expensive. $1,075 per 1-by-1 spread. Here's one way you're going to give yourself a little bit less of a reward if the stock actually moves more than expected and to the upside. Now, once again, you can do these strategies if you want to lean bearish. There's no reason that you have to lean bullish. It's easier to talk about the strategies this way. If I look at the bullishness of the platform, that's the path of least resistance. The platform is thinking to the upside. So take that back, modify this. Here's where we're going to go. Okay, 340. And we're going to add a leg. We're going to take this back a little bit. We're not going to look quite at the 370. We're going to go 350. Okay, that's going to be our buy. We're going to sell 2 of the 360s. All right, and we're going to make that 2. So we're going to set this up as a butterfly. Now remember, I'm saying this is an alternative to a long call spread. And then we're going to look at the 365. Okay, now it's important to note here that this is 10 points wide and this is 5 points wide. 1 by 2 by 1. If we were just looking at a long call spread, you'd be 1 by 1, right? You'd buy 1 and sell 1. Here we're still looking for the stock to go towards 370. We're still okay with that trade. And if we look at the profit and loss graph, it shows you that. But now we bring down the cost quite a bit, quite exponentially on the trade. We don't have as much upside, but we're looking at $2.23. And on the upside, this has to trade for $5 everywhere above the 265 strike. We bring down the cost a lot because, first of all, we don't have quite as much upside, but more importantly, we are selling 2 option contracts and bringing in all that premium from the implied volatility around earnings. So if we look at this trade and the market goes right to 360, well, this can still trade for $10, which is the difference between this strike and that strike. That is the long call spread. That is, the alternative trade, I guess if you want to look at it, where you're buying the 350 call, selling the 360 call. We sell 2 of them, And then on our short spread, we're only going 5 points wide. So if this is 10 points, this is 5 points, that means anywhere above the 365 strike, the butterfly, which is the long call spread alternative, has to trade at least for $5. 10 minus 5 is 5. Paid $2.23 for the trade. Anywhere above this area, this would be profitable, and I'm trying to kind of highlight the profit and loss. There we go at that end of $5 minus the 233 or 277. Or if we do get lucky and it lands somewhere in the precipice of the butter at the peak of the butterfly, then the maximum that we can make on the trade is 777. $10 minus the 223. Oscar asks, how do you decide how wide the strikes will be? And okay, so if I'm looking at the law, Oscar, let me ask you this. Are you talking about the butterfly trade that is totally, a little bit off the wall here? It's one of my favorite trades to do. The platform doesn't really set up to look at butterflies, and it's more so that they're more advanced. Or are you looking at the width of the strikes on the long call spread? So I'm looking for an answer to that question. Yes, the butterfly. Okay. The butterfly, it really, if I'm looking at the butterfly, I want it to be within a 1 standard deviation move, or another way to look at it is the expected move. So there's two different ways to approach this. If I hit the 365 strike, we see that this is the delta. This is saying the delta is 25. Here's a 1 standard deviation move, and that's taking into account the pumped up implied volatility. Usually the marketplace, only 16% of the time, and you'll see that the delta, once we get beyond this, is going to be approaching 16, right around that level. The stock does not make that move beyond a 1 standard deviation move. So if I'm doing the butterfly, I want it to land in the middle. I want the potential to be that it would land somewhere about a half of a standard deviation move. So it has everything to do with, and I like to look at it as delta. So in this instance, when I'm going 10 points wide, I'm buying the 350, selling the 360. The 360 has about a 30 delta. Yeah, 31 is the delta on that. Saying there's a 30% chance, based off of the implied volatilities and where the markets are trading and the very liquid options that are in Alphabet, that the underlying stock could at least finish 1 cent in the money on the 360 strike. So I like to target that. And then if you come back and you look at it, this is the range where I like to sell the center of the butterfly. If you then it's really up to you about how wide and how much cash that you want to pay for that trade. And I do have a slide that kind of highlights this that I put inside the market review. But let's go down to the 240. You could say, okay, I want to do a 15-point wide trade, and I'm going to pay more. So we'll go down to the 345, which is right where the market is at. And then, so that's 15 points wide. Then ideally this would be 7 points, but I don't know if we got that half point strike. Yeah, we do. Okay, so then 367. Okay, so that's about half. So then this is 15 points wide, and then this is 7.5 points wide. Now it's given a decent score, and it's always going to give a solid score on this, mainly because you're not paying as much as you would be if you bought the long call spread outright. And this is kind of focusing on long call spreads, so you're almost always going to end up with a really good score here. Now, you're getting a solid risk reward, but the risk reward is harder to achieve because you need it to stop right at that 360 mark. Okay, but now we're going to pump up the price. And, our long call spread before we wanted it to get to the 370 level. We still were paying, over $1,000 for the long call spread, and here we're paying $3.90. The trade off is, a very almost triple the risk versus the reward. 390 if we would get the and 1,111, but it's much harder to achieve. So I want you to have realistic expectations. In order to achieve it too at 360 level, we need time to go away. We need this option contract that's trading for $5. If the stock were to stop right at 360, we want to pay as little as possible to buy back to close those 360 options. So keep that in mind, right? So I look this more as this is 15 points wide and this is 7.5 points wide. So if you take 7.5, 15 minus 7.5, that leaves 7.5 above and beyond the 367.50 level, and you paid 390 for it, right? If you can fill at the midpoint. Midpoint is never a guarantee, and I do get the midpoint there. Okay, 390, 750 minus 390. So my expectation would be that we would have the potential to make 360 on the upside. It's almost a 50-50 split in that way, but it's well within the range that it could reach that level. All right, so before the end of the show, want to pull up the PDF per requested and look at some of the moving stocks this week. And we've changed it up a little bit inside options play on the research. And let me go pull that up 1 second here. And if you have any other questions, put them in. I do have a couple other. Amazon's announcing earnings on Thursday. So you actually legitly have a zero DTE trade that you could consider. Pulling up the research report right now. And I think I'm just going to bring it over. Yeah, it's not going to let me do that. 1 second. And there it is. Okay, so zoom in a little bit. So a quick review. So the focus is on Meg 7 and Magnificent 7, Amazon, Alphabet that are announcing earnings, and that's kind of what we're aiming at. Meta did take a 10% plunge, and one of the biggest, Meta goes back and forth as far as the market is concerned on, they like the fact that they're spending, that they're trying to, at one day, I should say, day one, they're okay with the fact that Meta is spending, that they're almost thinking about becoming an energy company to try to power their AI. And then the next day, on day two, they're like, nope, you're spending too much. And that's what seems to be the battle with Meta. They like the AI approach, but then they look at the type of money that is being spent by Meta to try to pull off that. And we saw a 10% plunge in that. Microsoft also got beat up. That kind of brought the stock back down. Here are some of the equity outperform stocks. Gilead. A lot of these are, well, the CME is an interesting one to me, but the option contracts are not as liquid. I think the platform highlights them as somewhat liquid. I think that is being generous. But these are, the CME is the Chicago Mercantile Exchange, and it, based off of trading, and we're seeing option trading volumes go through the roof. Also futures trading, and getting into the CME, one of the biggest news is they're getting into the probability markets and they make markets. And that's a great skill. They have a lot of people on their trading floor that can do that. And that's what the probability markets need, is somebody to start to make markets in that and take the other side of trades when there's nobody there to take the other side of trades. Hence the liquid marketplace. So very interesting what's happening with CME. Also the Chicago Board Option Exchange, CBOE, is another stock that is announcing earnings, and I find these companies to be interesting. Coca-Cola, you know, some of the staples are coming in, and I don't know if you want to say that it's protectionist against I hate to even say the word, possible recession, but you're seeing some of the staples perform, and these are a couple of the stocks that are highlighting that. Obviously, you look at gold and what's happened with gold, and you see on one hand we see the markets setting all-time highs. On the other hand, we still see a flight to quality and a flight to safety, and that's where Colgate and Coca-Cola are at. XLE, this is the energy is the macro outperform. I also XLF was in last week's report, but I like the financials in this area. Obviously, if things were to turn, I don't see any reason, right? Let's see what Tony wrote here. The week ending. All right. Yeah, nothing over the top. So here's the KO chart, and this is, oops, don't do that to me. Okay. Look at the strong breakout on Coca-Cola to the upside. It recently broke out on the 73 resistance, and it didn't kind of break out. It made a real strong breakout to the upside. This is one of the stocks that I was highlighting. I actually used it in a daily play that I put out for options play, and it broke out to the upside, 73.90 upside target, solid P. But we know that Coke is one of the best run companies as far as management is concerned, and it highlights that in the net margins. Coke has always had very strong net margins, decent expectations across the industry, but obviously an industry leader. This to me is much more about the fact that we had to break out to the upside as far as Coke is concerned. Let's go and what are the other stocks? XLE. Gilead up today. Very well. If you want to look at the drug manufacturers, this is one of the, I guess, undervalued, if you will, in that space. PE is solid, rest of the industry, but the expected growth is extremely strong net margins. That is a stock, but actually did get a bearish signal. Only all that is a reversal trade once again, in that the stock is up so strong that it's the CCI down here shows you relative strength of the marketplace, says that it's time for it to take a little bit of a break. But that is an interesting thing. What is the other one that I wanted to look at? This is not a very liquid stock for trading options. I like the chart right at this range. If you can break out to the upside, the next stopping point is right up here. But once again, a little bit overdone. When we might get a counter trend signal here in this one too. Solid net margins. This is in the financial space. Ameriprise Financial, very strong move to the upside, very good earnings report, and it broke out to the upside, but it's very hard to trade options in it, but a lot of bullish signals. This would be more so a stock purchase, looking at a potential covered call on this position on Ameriprise Financial. But like I said, I like a lot. Here's Colgate Palmolive. Look at that move to the upside after earnings. Potential bounce here, broke out above its 87 resistance. Attractive risk reward. Uh, it is interesting to see that a lot of these staples, Colgate, Palmolive, CL, that I find it interesting to see the dynamics of the marketplace. The Meg 7 are not driving the markets higher. It is, the equal weight S&P 500 index has actually outperformed the standard S&P 500 index recently, which is a good sign. It's, solid markets, but you're seeing a flight to quality in a lot of these stocks. And Colgate is another one of those. All right. Q&A. All right, thank you, anonymous attendee, for your feedback, saying butterfly trades are beyond the scope. And if you can share Tony's presentation in the future and not get off on sidebars. All right, I appreciate the feedback, anonymous. And here's the CME group, and this is the solid trade to the upside. But if you're looking at the capital markets in the CME, it's more so the prediction markets. A lot of the exchanges are trying to get involved in them, and there's nobody that can make better markets than the marketplaces that are trading options at this point in time. Coinbase is also an interesting one, but they focus a little bit more on crypto. CME is kind of flown under the radar. Strong move to the upside and has had, trades at a decent PE. Let's go and look at the forward PE here. Expected earnings growth 6.5%. Net margins are really strong in CME. Very well. Well, they've been around forever. The good old bread and butter is what the exchange used to be. I used to work across the street from it at the Chicago Board Option Exchange. So CME's bread and it used to be called the Bread and Butter Exchange way back in the day. And another stock that I find, once again, in the financial space, Truist Financial is just a solid company. I don't know. I don't want to like overdo it. You want to look at the book ratio more so than the PE ratio, but the PE is low, and also the price to book ratio, which is how they manage their assets. It trades at one time price to book versus the industry of 1.38. That's a very solid price to book. They're doing very well with their capital. There's room for growth on that, and then a very solid net margin. And once again, a nice, strong upside move in Truist Financial overall. Are there any other stocks inside the presentation that you'd like me to highlight? Those are the stocks that I was looking at. Another recent trade that I did to get bearish on the market is ABBV. Abby, there was a little bit overvalued. This would be my one bearish trade that I would leave you with heading into the market. And we did get the bearish signal this week. Earnings are on the 4th, which is tomorrow in the AM. Have the bearish signal that is a bearish trend following signal. And I'll pull up the chart one more time. Okay. And you see a lot of chop in the underlying stock. The marketplace is saying, or the trend following says that we've been in a bearish trend to the downside. This has been the trend. Lower highs all the way on down. And then we had this move up heading into earnings. We are, we did have this crossover of the 20-day on the 50-day, but this has been a period of consolidation, and being a little bit overdone, that leans to the bear side, and that is the earnings navigator highlighting that inside Tony's report on AbbVie. So the trend here is going to be bearish based off of this trend following scenario. As far as the platform is concerned, the bullish in the last past month, we've had a bullish move, fairly strong move to the upside, saying that the earnings could be a catalyst to push it to the downside, and you actually get a decent risk reward on it if you wanted to lean bearish on a trade. That's that is the one stock that I highlighted inside the research report that I actually did a bearish trade on this week and sent it out. Okay. See, so two stocks that Lydia would like me to look at is, I'm assuming, I don't know this symbol right off the top of my head, CTRE, Care Trust, oh, Real Estate Trust. So this is not going to be liquid. This is not going to be, this will be more of an interest rate play than anything. Right now, it looks like we're in a period of consolidation on the chart. But we got the 20-day, 50-day, and so it looks like we've had a solid move in the underlying stock to the upside. February 12th is the earnings. It's going to be after the close. But the chart looks like we're in a period of consolidation right now, trying to figure out where it wants to go next. But I don't know much about the Care Trust Real Estate Trust, and that's not going to be my expertise. It's not a very liquid thing to trade options on, but the chart doesn't look bad. I wouldn't be too scared by just looking at the chart on what's happening, and it looks like you had a solid move to the upside, and I'm sure this thing has a very nice dividend yield, and it does, as with a lot of real estate trucks. But I'm happy to look at ET. Yeah, we're getting, well, this is as exact of the counter trend scenario in that you had a strong move to the upside, it got a little bit overdone, and then we saw a fall off. So we might have even seen a signal here on the bearish side when it happened, but now the fall off is to the downside. That's the only thing that I don't like about the ET trade here, is that you just had so much strength. The strong earnings report, you got all your ducks in a row. You got the 20-day and crossing over the 200-day, which that's a bullish sign. The 50-day crossing over the 200-day, so that's a very bullish sign. It's just you're getting a little bit overextended relative to the 200-day. So the earnings might be a reason to sell it off and take some profits. And I do think that when you get a type of move like this in an energy company, that is a very feasible thing to do, but it doesn't mean that you should get out of the stock. It still trades at a solid PE ratio, and energy transfer in this space, obviously energy companies have been doing well. Uh, Ryan, I don't know as much about the PDF and what's made available. Um, I'm just filling in for Tony, if you will. And let's see where we're at. We got one more minute before the market's open. So I went a little bit long. And this is the earnings navigator, and this highlights the overvalued and undervalued stock as we head into earnings. Palantir is a tough one. They got beat up after their earnings, so this actually was relative inside their earnings navigator. But I wouldn't want to touch that stock, honestly, just because, well, it's just in the news headlines and it's really driving solid company, solid management, but a lot to do with government contracts and where we're at and market close. I'm gonna go back this way, and I can scroll down. All right, I'll highlight. I'll work through the PDF as Anonymous asked me to do, and we'll try to highlight some of the things inside, and then we'll call it a day here. So these are the stocks in the equity outperform. I highlighted the ones that I thought were the most interesting. Colgate and Coke are the two most interesting outperform stocks here recently. CME and also CBOE are interesting in the fact that the prediction marketplaces are coming to these exchanges and they're trying to get deals done, and that's being shown. People are usually the marketplaces kind of ride under the radar. They're very well run. The way that a lot of them, they weren't public companies for the longest of time. When I was in Chicago working on the exchange, they were not public at all. And now they have gone public, and they see that, through the trading fees and that they just can had very solid earnings, usually outperform time and time again because volumes continue to creep up. So this volatility helps these exchanges, and then you throw in the prediction markets, and that's the one thing that they're really good at. And then the other area that I really like is the financial area, and obviously this is XLE, which is the energy area. But I like the financial markets. In particular, Goldman Sachs is an interesting one in that they're an investment banking firm, and deals are becoming a little bit more and more prevalent in this marketplace with this administration, and Goldman Sachs has been rewarded from that. JP Morgan got beaten up a little bit by it, but that had a little bit to do with the news headline about the credit cards and the capping of the 10% interest rate, which now that is old news. I guess it gets mentioned from time and time again, but it was a shocking statement, and I don't think it's going to happen in that range, and I got a little bit beat up on that. So did Citigroup and even Citibank. Took it a little bit hard. So let me keep scrolling on down. Here's the macro, State Street Communication Services sector, XLC. That has been a strong sector of the marketplace, but it hasn't really been something that I've had an eye on. But if you look at it, you can see that this had a strong breakout to the upside, and this is kind of what Tony's highlighting inside the report. XLE, we all know that bounced recently. Gilead, highlight this one a little bit. Let's pull it in just a little. There we go. The equity outperform ideas. Here's the chart. And then I'll scroll down and I'll scroll through the rest of them for you. Utilities, PEG Service Enterprise Group. This actually is very interesting if we do get this breakout here. Now we're 29 days away from earnings, somewhat liquid, but obviously this space has done well, and this is a company that has that potential. Now, it's hard to trade options in it. It says somewhat liquid, but I've looked at the markets, and they're a little bit wide, but not a bad, if you're looking to be in this space, not a bad underlying stock to consider and trade. Ameriprise Financial, I love the financial space. CME Group, we looked at that one. Truist Financial, another one of the banks in that space that has solid potential to the upside. Looks like it's just ready to break out too. We're sitting right here at this 51.42. I wonder where that stock is at right now. What has happened recently? Let me pull up a quote on that. Because I do like this one too, but now once again you're in a space where trading the stock is you're going to get better markets. It's somewhat liquid though. This one's not quite as bad as PEG. Yeah, right now it's indicating up 1%, 53.19 at this point in time compared to 51. So this stock has done well. So since Tony's added it, it's actually up a couple of dollars from this point in time on a $53 stock. That's a pretty strong move. And then Coke, and then that's it. That's the earnings calendar going out, and here's the earnings navigator. All right, I'll ask a couple more questions, but the markets are open right now. We actually see the S&P 500 index up 7, or 0.1%. Gold is up again. VIX is at 1620, and we're seeing the NASDAQ up also about 0.1%, up 19 points at this point in time. It's good to see the Russell 2000, and this is another one of those, head scratchers to look at the Russell 2000 and the performance that it's had, but then you see the flight to quality once again in Coke and in Colgate, and you're seeing some of these stocks that are protection stocks. But then again, the Russell 2000 has recently set a new 52-week high, and the index has done well. Usually when small caps are doing well, the market's doing well in general. Lower interest rates help. Long-term rates, though, still are stubborn. They're not coming down. And that's part of the reason why I like the financials, too, because you're getting a nice curve, the 10 versus the 2, as far as the yield curve is concerned. The bigger the dispersion between the two coming down, the 2-year yields and the 10-year yields going up is usually a good thing for most financial companies. All right, everyone. Well, I don't see any more questions. I think we answered most of them. Thanks for sticking around. Appreciate it. Tony will be back next week, and I hope I add a little bit of, a little bit of my favorite trades that I like to look at, especially during earnings week. This is one of my heaviest trading weeks right here, and it's not always good to speculate around earnings, right? But you want to be able to manage your risk and understand those positions, and sometimes butterflies can help with that. But you still got to be right about your forecast and about the underlying stock. And I'm going to emphasize one more time, too, that nothing that we did today is meant to be a recommendation. And past performance is not a guarantee of future results. And we'll call this a day. Let me pull up my slide. Well, you know what? I'll just do this. Instead of trying to find it after grabbing the PDF here, I'll just leave it here. Thanks for stopping in, and we'll see. Tony Zang will be back next week for the next edition of Options Play Trade Ideas and Research. Thanks for stopping in, everyone.